Question I always get asked is how can you earn yield in a bear market, right? And what actually strategies do you implement to preserve your capital, protect your portfolio, and ensure that when the market goes down, you are positioned properly for when the market goes back up? Now, I want to very quickly clarify something. A lot of people focus on not losing money during these markets. But what they don't understand is you only lose money when you actually sell out of your positions. I think a lot of us also believe in the overall crypto market and believe that crypto is going to do well over the next 4 years or so. So in that case scenario, we should be focused on acquiring more crypto assets using instruments in DeFi to build our portfolio to a larger Bitcoin level or amount of Bitcoin in our portfolio, just as an example. And then from there, when the market goes back up, we have significantly more profits. Let's take a look. Let's just say you were to have $100,000 in your portfolio right now. And currently, Bitcoin is trading at roughly $67,000 or so. When you equate your portfolio to Bitcoin value, you essentially have a little over 1 Bitcoin basically. Well, our goal is to take that 1.48 Bitcoin value of your portfolio that you have right now and turn it into more, right? Turn that into 1.6, 1.7, so on and so forth. So in this case, let's just say your portfolio falls to $80,000. You are down money. You have not locked in losses yet, but you are down money. But let's just say Bitcoin falls to something like $40,000. Well, in this case scenario, Bitcoin fell significantly more. So you now have 2 Bitcoin worth in your portfolio. But you've outpaced the market because you're earning yield and you're strategically compounding that yield through what we call and what we coined as a flywheel system. Now here's another example because it does not always work in your favor if you're allocated to high-risk altcoins you haven't done your due diligence. Same scenario, your portfolio falls to $80,000, but this time Bitcoin is not at $40,000. Bitcoin is at, let's just say, $60,000. Well, in this case scenario, your portfolio has fell significantly more and you have 1.33 Bitcoin in your portfolio. Once again, this is just a mere example. Maybe your benchmark is not Bitcoin, maybe it's ETH, maybe it's a basket of assets. But my point is I challenge you to start to benchmark your portfolio somewhat like this. So let me show you how I actually implement these strategies though in my portfolio and focus on accumulating more assets without having to take out my wallet and put more money into the markets. So using Metrix Finance, I look for correlated liquidity pools, specifically with the assets that I already believe in. One of the things that a lot of people do that is completely and utterly wrong is they look for pools first before looking for assets. That means they go over to Metrix Finance or DeFi Llama or one of the other many tools in the space. They select all the exchanges, all the networks. They go and they sort by APR, and maybe they'll throw on some constraints like TVL greater than $1 million or something like that. But truth be told, this is just going to give you a bunch of noise. It's going to give you a bunch of pools with assets that, frankly, you probably don't believe in because you are now blindsided by the yield that they display. Whereas what I do that's different is I go over and I find assets that I believe in. Usually these assets are rotating every 6 months or so. Some of them have been in my portfolio for 2 years. Let's just say one of them is going to be Hyperliquid Hype token. So I'll go over to Hyperliquid and I'll figure out what networks it's on. And I will select, in this case scenario, HyperSwap and Project X. I'll go and then I'll select the Hyper EVM chain. And then I'll start to look for pools with Hype in them specifically. And if there's another token that I actually believe in as well. So in this case scenario, I would probably want to pair Hype with something like Bitcoin or ETH, because I'm assuming that it's going to be correlated, but we have to do that further due diligence. So in this case scenario, let's put in BTC, ETH, and then it's going to show all the pools with Hype, BTC, and ETH in them. And we literally only have 6 options here. It's not a pain to sort through all of them. We're not investing into assets that we don't believe in. We're just investing into solid pools that we actually want to allocate capital to. Now, as far as TVL goes, we can put constraints on here. We can filter things down, do all the fancy things, but we really don't need to because there are 6 options right here. So what we do is we evaluate the one with the top TVL first for Bitcoin and then top TVL first for ETH. And then from there, we start to look at the other options to see if they produce a better yield. These ones with lower amounts of TVL, like 200K, I'm not even going to worry about. And the reason why is because I'm typically deploying $20,000 per pool. I don't want to make up for 10% of the liquidity and end up being the exit liquidity. Now, granted, it's not a huge risk because there are plenty other pools with higher amounts of TVL for Hype, but it's just something that you still should focus on. But anyways, now moving into the simulate page on Metrix, we're going to put our deposit amount first. say $20,000. The next thing that we're going to do is we are going to zoom out to a 30-day calculation time frame so we can look at the price chart over the past 30 days. Now, it's important to realize that this price chart represents how many hype tokens are in one Bitcoin, not the dollar price of Bitcoin, not the dollar price of hype. How many hype tokens are in one Bitcoin? So at current price, there are 2,325 hype tokens in one Bitcoin. And when this chart is going sideways, that means that there still is trading activity, there still is people buying and selling, but at the same time, they are correlated, meaning they're going up together and going down together. So in this case, I will lower my min price to roughly this 30-day low, and I'll raise my min price to roughly this 30-day high. But this range is way too broad. It's going to essentially not be efficient because we have all this extra space over here. But also we want to find a balance. So I'm going to start to bring this min price in a little bit, right over here to maybe a key level, and then add a little bit of space. So this is the key level I'm basing it off of, and that's February 7th, and it is currently February 27th at the time of recording. So I add a little bit of space, and I make sure that if the market moves X amount in whatever amount of time period, like a day or two, I can actually capture that on the upside and downside. You're looking at the market moves to ensure if we see a similar market move, we don't instantly go out of range. And then my max price, once again, I'm gonna find a level, something like this, but then that's too close, so I'd have to bring it up a bit and make sure I add plenty of room for the actual level over here. Another thing that we pay attention to in liquidity pools when selecting ranges is the actual percentages of each asset that we have, the ratio of assets in the pool. This is about 50-50, and in my case, I'm happy with that. But there might be scenarios where I want more hype or more Bitcoin in this pool, so I would have to adjust my range accordingly. Now, it might look great because it's showing a 208% APR. There's a couple things that we need to do to make sure that this APR is accurate. The great thing about Metrix that no other tool implements is that it is composable, meaning that you have full control over your calculation, and with more control comes more responsibility. You need to make sure that you are actually investing the time to make sure that your APR is accurate. Otherwise, you're going to make your decisions based on a 208% APR. You're going to dive in and you're going to get a 50% APR, and your decisions are going to be completely inaccurate. So in this case, what I will do is I will go back to my calculation time frame now that I've selected my range, and I will select a period that is consistent. You can see that the volume has declined greatly over the past month or so. So really, when I'm looking at my calculation time frame, I only want to look back since February 16th, maybe February 15th. So let's just say our calculation time frame is 12 days. That is a lot more consistent, and it's actually growing in the recent days, meaning it's likely that we will get a little bit higher. Now that's showing a 78% APR, but don't stop there. There's a couple more things that we have to do. This liquidity distribution chart shows where liquidity is. So in this case scenario, at the current price, there is $111,000 of liquidity. Right to the right of the current price, meaning that the price goes from $23.41 to about $23.55, there's $130,000 of liquidity. Now, when we go to the left, as we start to go down in price, you will see that there's less and less liquidity. Similarly, if we go far, far to the right, once again, less and less liquidity. We need to estimate based on the current price, the average, as well as all of the outlier prices, so we have an accurate depiction of what's happening in this pool. So current price, we just have to click on it. We click right there, and it will show you are doing a 44% APR. Not bad. I'm actually pretty happy with that. Now, if we go to the peak of liquidity, where the most liquidity is, we are doing a 37% APR. We go over here where there's slightly less, kind of a balance between. We are doing a 56% APR. Over here, we are doing a 107% APR. Over here, 93% APR. So how exactly do we base our investment decision? Well, usually I'll base it on the next to top price. So over here, we have kind of peak liquidity. I'll base it on the current price, which is 44% APR. And then from there, I need to evaluate to make sure that this pool is actually a good investment and make sure that it's worth it getting in the pool, and the yield is going to outweigh any associated cost with being in this pool. Once again, our goal here is to acquire more assets, and liquidity pools have divergence loss, so we have to always factor that in. The last thing we want to do is invest into a pool and then once again end up with fewer assets or lower Bitcoin value or lower, say, hype value or whatever your benchmark may be. So now I look at CoinGecko. I'm looking over here at Hype token, and I'm also looking over here at Bitcoin token. Now, I'll start with Bitcoin just because it's a more popular asset, and that's typically how I'll do it. I'll select a 1 month time frame here, and I'll look for a period where the market moved up. Now, the market moved up over here, 63.2K all the way up to, say, 69K. That's over the course of literally 2 days. So let's just say 63 to 69. That right there is a 9.5% gain. So then I say, what happens if Bitcoin's current price goes up 9%? So we'll do that times 109%, which gives us the new price of $73,000. And then we do the same exact thing for HYPE over the same exact period that we selected for Bitcoin. So that period was right over here. And we're looking, HYPE went from $25 or $26 all the way up to $28, nearly $29. So let's say 25 to 29. And that is a 16% gain. Once again, taking the price of HYPE over here and just multiplying it by now 116%, which gives us 33.66. And that's the new price of HYPE. Well, now that we've pasted both those numbers in, it says, hey, Jake, if you just held your HYPE and your Bitcoin in the market, you did not invest in the liquidity pool, you did not spend the time doing this or managing the pool, and you did not take the risk, most importantly, you would have $22,523. But the liquidity pool has $22,367. That's a $155 difference right there, which is your divergence loss, also known as opportunity cost. That's the assets that you lost. Now, keep in mind, we have not factored in the yield yet. So what we just looked at was essentially Bitcoin and HYPE going up over a roughly 2-day period. Well, what this tells us is it will take 6 days to cover that price difference. Now, I would say in this case scenario, it's not something that I'm going to jump at and immediately just start throwing my capital at. However, it is something that I'm just going to evaluate further and look at the downside, look at other upside scenarios to truly ensure that this is a good investment. But in this case scenario, let's just say we're in this pool for 14 days. Well, as you can see right over here, we now are actually beating the HODL strategy with $22,700. So that's exactly how we're evaluating pools in the bear market. We're focused on acquiring more assets through our DeFi flywheel mechanism. Now, if you guys want to sign up for Metrix, there's going to be a link at the top of the description. And I'm also going to link you guys to another video that breaks down my entire flywheel system that will help you make better decisions in DeFi. Now, I made that video a couple months ago when the market was obviously truly different, but those same exact fundamentals apply. The clients that we help deploy over $50 million in capital at Builder Wealth are using this same exact strategy right now. And we're using the same exact strategy because our strategy is always acquire, acquire, acquire. It's like your crypto retirement account. And we're essentially creating dividends from it to reinvest those dividends. Now, if you guys enjoyed today's video, you guys want more videos just like this one, make sure to drop a like, subscribe, notifications turned on. And I'm very excited to show you what we have in store for Metrix over the next couple months, especially with our upcoming V4 upgrade. I'll see you guys later. Peace out.